One of the more notable paradoxes confronting the student of securities is that while prices are set by arithmetic, their movements are governed far more often by psychology. I say this because the particular theme I wish to pursue at this hour is the indispensable rule, which I have pressed upon my readers and my students for many years: never to invest without a substantial cushion, a margin of safety. By that I do not mean a pious hope, an optimistic forecast, or a rhetorical wish that the facts will be kinder tomorrow than they are today. I mean a calculable, deliberate, quantitative cushion between the price you pay and the value you can reasonably ascribe to the asset you buy. The margin of safety is not, as some would have it, merely a quaint phrase. It is the central concept of investment. Without it, what you call investment is often mere speculation, dressed in the garments of respectability. Now let us observe the logic of this proposition. If an investment is to promise safety of principal and a satisfactory return, those promises must be made upon facts, balance sheets, statements of earnings, the record of dividends, and reasonable projections of future earning power. In the absence of a margin between the market price and the intrinsic value which those facts support, the slightest error in judgment, the slightest misfortune, or the faintest change in investor psychology can convert an anticipated gain into a painful loss. It follows, then, that the protection of the intelligent investor rests less upon his ability to predict the next turn of prices than upon his insistence upon paying significantly less than the value disclosed by a careful analysis. You might say that this instruction is almost trivial, yet it is astonishing how readily the average investor ignores it. When prices are moving upward, when the majority are euphoric, it seems almost indecent to demand a discount for safety. Conversely, when prices decline, when pessimism rules, the very attribute that ought to command the highest price, a margin of safety, is often scorned. Mr. Market, in his unpredictability, will offer you shares at an absurdly low price one day and at an inflated price the next. Your task is to take advantage of his absurdity by buying when the price offers you a cushion and by selling when the cushion disappears and the risk becomes unacceptable. Permit me to be explicit about what I mean by intrinsic value and how one arrives at it. Intrinsic value is, simply put, the present worth of all future cash flows to which a security is entitled, discounted at an appropriate rate to reflect both time and risk. Now, the calculation in practice is rarely an exact science. It requires judgment, conservatism, and a willingness to assume the worst plausible scenario. That is why the margin of safety must be generous. If your estimate of intrinsic value is subject to error, and all such estimates are, the margin of safety will absorb the miscalculation. If your estimate embodies optimistic assumptions about growth, then the margin must be larger. If your estimate is based upon the liquidation value of net current assets rather than on projected earnings, as in the case of a distressed or neglected company, then the margin need only be sufficient to compensate for the uncertainties of going concern versus liquidation. In short, the size of the margin must be a function of the quality of the estimate and the risk inherent in the business. Now let us consider the forms that a margin of safety may take: cash in the bank, short-term government securities, a high dividend yield, a balance sheet heavy with tangible assets. All of these are manifestations of conservatism. But more precisely, when I speak of purchasing a stock at 2/3 or less of its net current asset value, I am describing an extreme form of margin. In such a case, even in the event of business failure, the investor who purchases the net at the bargain price should have a reasonable chance of recovering his capital. This is not to say that these nets are common. They are, in fact, rare in attractive markets. But the principle is the same, whether the margin stems from current asset discounts, low price-to-earnings ratios, strong book value relative to price, or simply a high quality of bond security purchased at attractive yields. Allow me to emphasize here something that students often overlook. Margin of safety is not synonymous with diversification. Diversification is prudent insurance against lack of knowledge, and I have recommended it for the defensive investor, but it is no substitute for buying with a margin. Holding a dozen poorly purchased securities because you hope that their mistakes will cancel each other out is not the sort of discipline I would recommend. If each of those dozen holdings carries little or no margin, the probability of loss in aggregate is simply multiplied. What sensible analysis requires is that each purchase carries with it an independent cushion against error. I should also make clear that the margin of safety is not an abstract moral quality, but an economic fact. If you purchase a high-grade bond at a yield that adequately compensates for the risk of default and for the time value of money, you have a margin. If you purchase a common stock at a multiple of earnings that is justified by the company's prospects, conservatively judged, you have a margin. If you purchase at a price that represents a substantial discount to the conservative appraisal of net asset value or going concern value, you have a margin. It is useful, I think, to view margin of safety as an insurance policy you pay for at the time of purchase by insisting on a low enough price. You pay less, and in return, you reduce the likelihood that unforeseen adverse developments will impair your principal. Now, having set forth the principle, let us examine the environment in which investors must make such judgments. There are three key elements: valuation, yield, and psychology. Valuation refers to the relation between price and value. Yield refers to the return, current and prospective, that the security is expected to provide. And psychology refers to the market's temperament. These three elements interact. High prices relative to earnings and assets typically compress yield and reduce the prospective margin. Conversely, depressed prices expand margin and enhance yield. But it is psychology, the oft-ignored element, that determines how these forces play out over time. Historically, markets have shown a propensity to behave like a voting machine in the short run and like a weighing machine in the long run. Prices, therefore, may swing to extremes of optimism or pessimism. Not infrequently, they do so without any substantial change in the underlying facts. Consider earnings in a particular year. Earnings may remain roughly constant over several years, while prices double or halve owing to shifts in sentiment. The investor who believes that prices always move in proportion to fundamental changes will be repeatedly surprised. The intelligent investor, by contrast, views short-term movements as opportunities rather than as proofs of new economic law. Now, let us observe the characteristics of speculative markets. They are marked by several recurring features. First, there is an influx of new participants who believe that the market's recent advance proves a new era of prosperity. Second, there is imaginative expansion of credit facilities which reduces the immediate buying cost for a greater number of purchasers. Third, there is speech, writing, and commentary that justify the advance with elaborate theories of permanent structural change. Finally, there is a substitution of hope for analysis. People buy because they believe prices will go higher rather than because the business is demonstrably undervalued. You might ask, what distinguishes intelligent entrepreneurship from mere speculation when both seek profit? The difference is that the entrepreneur applies judgment to ascertain value and insists upon a margin between price and that value. The speculator substitutes the expectation of price change for any concrete estimation of value. The speculator is not necessarily wrong in every instant. Many speculators in a rising market enjoy large gains. The point is not to label them as foolish for their profits, but to caution the investor whose fundamental obligation is the preservation of capital. Do not confuse a speculative gain with an investment achievement. The former may be transient. The latter is founded on the economic reality of the enterprise. It follows then that an investment philosophy built upon intrinsic value and margin of safety will at times be countercultural. It will demand patience in rising markets when others are euphoric, and courage in falling markets when others are despairing. Most people find such restraint difficult. The human heart is not constructed to admire a bargain in the midst of surging prices. The natural impulse is rather to join the multitude. This is precisely the reason why the margin of safety is so valuable. It allows one to remain calm and to act independently without suffering ruin when the majority is carried away by emotion. Let us now turn to the practical aspects of implementing the margin of safety rule. First, one must classify the investor. Are you the defensive investor who desires freedom from effort and anxiety, or the enterprising investor prepared to devote time and skill? To the defensive investor, I have generally recommended a simple allocation between high-grade bonds and common stocks of well-established companies, with the proportion varying perhaps 50-50, but with a floor and ceiling, say between 25% and 75%, depending on relative valuations. Such an investor seeks safety of principal and is content with satisfactory return. The margin of safety here is achieved by confining purchases to securities that offer conservative yields and solid balance sheets. The enterprising investor, on the other hand, may seek special situations, bargain issues, or net-net stocks. For the enterprising investor, the margin of safety is often found in quantitative screens: low price to sales, low price to book, significant discount to net current assets. But even for the enterprising investor, the judgment must be tempered by an understanding of the business's durability. A margin will not be useful if the company is in irreversible decline and its assets are illiquid or overstated. A point I should insist upon is that the margin of safety must be computed in the currency of the investor's needs. For a person who needs income, a margin that comes entirely in the form of a claim on appreciating capital but offers no current dividend is insufficient. For a pension fund with liabilities, the margin must be reflected in both conservative valuation and reliable cash flows. In short, be sure the cushion you require is adequate to your purpose. Now let us discuss some common mistakes in the application of the margin of safety principle. The first is the substitution of hope for calculation. One hears the company will cut costs, or new management will fix things, or the post-war boom will lift sales. Such hopes may be legitimate inputs to an analysis, but they cannot be the basis for a margin. A margin predicated upon hopes is no margin at all. Second, there is the temptation to average down, purchasing additional shares as the price falls in the expectation that a lower average cost will produce a gain when the market recovers. Averaging down is rational only if the original purchase was based upon sound conviction that the intrinsic value remains above the purchase price. Otherwise, it compounds error. Third, there is the counting of unrealized profits as if they were identical to realized safety. Paper gains are useful as statistics, not as guarantees. Now, a word about the measurement of risk. Modern writers speak of volatility as risk. I prefer to measure risk as the likelihood of permanent loss of capital. Temporary fluctuations are the market's noise. They are not, for the patient and well-advised investor, a risk if they are accompanied by a margin of safety. Thus, a stock that swings widely in price but is purchased at a low multiple to conservative earnings is less risky than a high-priced issue purchased for speculative reasons. Investors who equate risk with the standard deviation of short-term returns misunderstand the purpose of investment. They are frightened by the wrong specter. We have spoken of margin in terms of initial purchase. There is nevertheless an essential dynamic to be observed. Margins disappear when markets rise. A high-quality corporation yielding 5% in dividends will be less attractive when its price rises and its yield falls to 2%. That process reduces the margin and converts a previously safe investment into a speculative proposition. The prudent investor is alert to these changes and takes corrective action, selling a portion, rebalancing the portfolio into fixed income or into securities with a restored margin. This rebalancing is not market timing in the speculative sense. It is the application of principle. Now, permit me to address the psychology of the market, which underlies much of our difficulty in adhering to these rules. There are several elements of human behavior that recur in market history. One is the tendency to extrapolate recent trends indefinitely. Because a business has enjoyed higher earnings for several years, the investor assumes that such growth is permanent. Another is herd behavior, the inclination to believe that the consensus cannot be wrong. There is also the disposition to interpret every piece of favorable news as confirming future prosperity, and conversely to see every adverse report as signaling doom. The effect of these tendencies is amplified by what I call Mr. Market's moodiness. On some days, Mr. Market is wildly optimistic and will value your share at an absurdly high price. On other days, he is despondent and will offer it at an unreasonably low price. Your job is to treat Mr. Market as a business partner who has mood swings. You can buy from him when he is irrationally pessimistic and sell to him when he becomes irrationally optimistic. This allegory serves to remind the investor that the market's offers are the servant of the rational buyer, not his master. I must emphasize patience. Patience is more than a passive sufferance of time. It is an active restraint, a refusal to be drawn into the excitement of the market. The successful investor is not one who predicts the next headline, but rather one who studies the business and is willing to await the market's recognition of value. Indeed, much of the virtue of the margin of safety is that it allows the investor to hold during periods of market depression without abandoning his conviction. Owning a security with a genuine margin allows you to sleep at night while markets roar. There is also to be noted the moral quality of independence. You are neither right nor wrong because the crowd agrees with you. You are right because your data and reasoning are right. This axiom is sometimes difficult to apply because the social rewards of agreeing with the majority are strong. Yet intellectual independence is, in my experience, the distinguishing characteristic of those who achieve lasting success in investment. The man who is always anxious to find validation of his views in the opinions of others will seldom hold fast to a position that requires courage. Now, turning to institutional considerations. There have been proposals, occasionally advanced with ardor, that public policy should limit speculative excesses by direct interventions, raising margin requirements, imposing transaction taxes, or restricting advertising of securities. Such measures may, in particular circumstances, blunt the immediate force of speculation, but their long-term effect is uncertain. Speculation is ultimately a social phenomenon. It arises from deeply human motives, hope, greed, and the desire for rapid advancement. Regulation can raise the cost of speculation and thus perhaps reduce its frequency, but it cannot eliminate human nature. That said, there are prudent measures the Federal Reserve and regulators generally may undertake to reduce the volatility that favors speculation over investment. To begin with, there should be sensible margin requirements. In moments of intoxicated credit extension, margin lending can amplify both the ascent and the decline of prices. A temporary tightening of margin requirements, properly administered, can serve to moderate speculative excess and thereby protect long-term investors from the consequences of a credit-fueled run. I would not, however, favor draconian or permanent constraints which might interfere with the granularity of market function. There is similarly a role for transparency in corporate financial reporting. Accurate, conservative accounting presents the investor with facts upon which to construct his margin. When companies employ creative accounting or aggressive capitalization of expenses, the investor's ability to ascertain intrinsic value is compromised. The public authorities and private standard setters should therefore insist upon clarity and conservatism in financial statements. Such insistence is in effect a means of preserving the margin of safety for the investing public. Another useful instrument is education. The best protection for the ordinary investor is instruction in the difference between investing and speculation. If a man understands that an investment operation requires thorough analysis and safety of principle, he is less likely to be seduced by the comparative glamour of speculative success. Schools of business and popular financial writers should therefore do their civic duty by explaining these distinctions in plain language. And now a few practical rules which I have found valuable over the years and which you may consider adoptable. First, keep speculative operations in a separate account and devote only a small portion of your capital to them. If you wish to speculate, do so knowingly and with funds you can afford to lose. Second, maintain ample diversification for the defensive investor, not as a plaster for insufficient analysis, but as a recognition of the limits of one's foresight. Third, demand quality in your bond holdings, adequate security, realistic yields, and conservative covenants. Fourth, in the purchase of common stocks, insist upon a clear margin. Do not rely upon the comforting presence of a name or a reputation. Fifth, re-examine your holdings at intervals with an eye to the erosion or restoration of margins. Do not assume permanence. It may be useful at this point to reflect briefly upon an objection frequently raised. Is it not possible to achieve superior results by abandoning the margin of safety rule and by trusting in superior judgment and timing? The short answer is yes, it is possible. There are, at any time, investors who can and do outperform the market by taking concentrated positions and timing moves with skill. But the record of those who do so over long periods is thin. Superior judgment, when sustained for decades, is rare indeed. The prudent course for the average investor is therefore to emphasize safety and to accept moderate returns rather than to seek outsized gains at the risk of ruin. To attempt the latter is to place oneself in the hands of a probability distribution that historically has favored disaster more often than rewards. Permit me to summarize the practical implications for portfolio policy. The defensive investor will allocate between high-grade bonds and a diversified list of common stocks with a reserve for cash to take advantage of pronounced market declines. The enterprising investor may seek bargains among issues selling at discounts to conservative appraisals of value, but he should confine such activity to a limited part of his capital and should proceed only with full acknowledgement of the uncertainties. Both types of investor should avoid the temptation to treat their securities as lottery tickets. The chief object is the preservation of capital with a satisfactory return. I should now address a final aspect of the margin of safety concept, its moral and civic dimension. An investment philosophy that cares for safety of principle serves society as well as the individual. When investors demand sound accounting, conservative management, and honest disclosure, the economy as a whole benefits from the discipline such demands impose upon corporate conduct. Conversely, a society in which speculative attitudes predominate, where the aim is to profit from the movement of prices rather than from productive enterprise, will in time experience financial instability and social disquiet. I therefore urge those in positions of influence, teachers, editors, and public officials, to inculcate principles of sober appraisal. And now, for the closing argument, let us restate the essentials without ornament. Markets, like men, have an appetite for exaggeration. They are prone to extreme statements of hope and of fear. To protect oneself against these excesses, the investor must anchor his conduct in the reality of intrinsic value and insist upon a margin between price and that value. The margin of safety is not a mystical talisman. It is a practical, measurable, and repeatable rule. It permits one to sleep at night when newspapers shout of crashes, and it permits one to act with independence when manias abound. Do not, in conclusion, imagine that the margin of safety is the whole of wisdom. It is rather an indispensable starting point. Intelligence, judgment, temperament, and the habit of continual learning are required companions. But begin with the margin, and you have a method that has survived repeated market cycles. Begin without it, and you rely upon hope and talent alone, two unreliable guardians of capital. The investor's first protection is not foresight, but restraint. The second is a careful, conservative estimate of value. The third is the margin between the two. These form the tripod upon which sound investment rests. Hold to them, and you will find that modest returns compounded over reasonable periods will deliver what most investors truly desire: security, independence, and the satisfaction of knowing that one's capital has been employed with prudence rather than with the unseemly haste of speculation. Remember finally that a margin of safety is not only a financial necessity, it is a moral pronouncement. It says that you will not place the security of your clients or of your own family upon the fickle altars of favor and panic. It is an assertion of the belief that value exists independent of current opinion, and that careful, sober appraisal is the rightful measure of a man's dealings in securities. Keep that cushion between price and value, and you will have created for yourself not merely a rule of money-making, but a rule of sensible living in the uncertain economy of men.